Okay, hello everyone. We welcome you to our Navigating the Ins and Outs of Equity and Fixed Income Investing seminar. This seminar is sponsored by IDB Global Federal Credit Union and presented by MG Capital Partners LLC, who was founded by Jose Sobrado, CFA. He's a licensed financial planner with expertise in working with cross-border and global clients. So before we start, everyone, just a couple of reminders. This webinar is being recorded and all registrants and attendees will receive the recording as well as the presentation material via email. So look out for that email from cu.marketing, probably about a week after this webinar is complete. If you have any questions for Jose, please use the Q&A tool to type in your questions and he will answer them at the end of the presentation. Your feedback is extremely important to us, so kindly fill out our survey that we'll be sending via email at the end of this webinar. So thank you, everyone. Enjoy the information, enjoy the presentation and the webinar. And Jose, the floor is yours.
Thank you very much. Welcome, everybody. It's a pleasure to be here with all of you today. Welcome to today's presentation. And my name again is Jose Sobrado. I'm the founder and president of MG Capital Partners. As previously mentioned, a registered investment advisor, and we specialize in offering wealth management for cross-border clients and international organization employees. My goal for today is to provide some basic general information and important and useful information for those of you looking to manage your own investment portfolios or considering how to do so in the future. Next slide, please. Here's the agenda for today. Our presentation will address general investing principles to consider and to keep in mind. We're going to have some discussion around how to design investment portfolio, efficient, smart investment portfolios, depending on your own individual needs and circumstances. Some advice about how to implement an investment strategy. And at the end, we're going to discuss a little bit about specific considerations and important issues for those of you, we know there's many out there that are G4 visa holders, of course, that may have unique needs when it comes to investing and managing an investment portfolio. Next slide, please. Just a brief disclaimer. Of course, this presentation is meant to be purely educational. Nothing that I can say today should be considered investment advice, individual for specific for your own circumstances. Please know that investments involve risk, and be sure to always consult with a qualified professional or a financial advisor before implementing any of the strategies or the investment suggestions discussed today. Next slide, please. Let me begin by pulling up these two quotes by well-known successful investors that I think are a good way to frame the discussion today around what it means to be a good investor and a good long-term investor primarily. According to these two individuals, investing is not necessarily about being smarter than somebody else or beating the market or beating the performance of other investors in absolute terms. That type of thinking by definition requires perhaps some level of greater intellect, particular skills, or more resources than other investors. That's not necessarily how these individuals see investing. They see investing more as a process, a logical process based on a framework, a strategy, a lot of planning, and disciplined execution of that strategy. And they see investment, much like I do, as something that is measured not just by what you earn, what's the performance of your portfolio, but what you get relative to the risk that you assume, right? So it's as much about managing risk as about the performance of your investments. This is probably in some respects the difference between speculating, and investing. So today we're going to focus more on what it means to be a true investor rather than somebody who just buys securities and speculates on the future price of those securities. Next slide, please. So with that framework in mind, what can be some of the possible consequences of speculating too much with your investments rather than investing in the disciplined and structured approach that was previously suggested? According to JP Morgan, during the 20-year period ending in 2018, which is what you see here, the average retail investor, so non-professional investors, the average retail investor earned a very low 1.9% on average on their investments, compared to the S&P 500, which earned 5.6% over the same period, and compared to a much more conservative 40-60 portfolio, in other words, a portfolio that invests primarily in very safe fixed income investments, which earned 5.9% over the same period. The average retail investor severely underperformed any other possible investment that was available, that could have been available during that period. So clearly there is something that the average investor is probably not doing right. And what I hope to convey to you during this presentation are what could be some of the mistakes or common mistakes that can be avoided when approaching an investment strategy, in order to hopefully make sure you're one of those investors who is closer to a good, efficient portfolio performance rather than the bad performance of an average retail investor. Next slide, please. So I'm going to spend a little bit of time discussing some important principles of investing, and I'll begin with reinvesting. Reinvesting of interest and dividends can be a very powerful tool to an investor. So according to this graph, as much as 58% of the total return for a bond portfolio and 45% of the total return for an equity, for a stock portfolio, can depend on the reinvesting of dividends and interest. In other words, if you don't set up your investments for that automatic reinvesting of the interest and dividends that you're going to receive as an investor, if you're not taking advantage of that mechanism, you are at risk of severely undermining the performance of your strategies. If you are the type of investor who is going to have your dividends and interest put in a separate account where perhaps you might be spending it, or you're going to sit by and wait for what you might think to be the right time to invest those proceeds, you run the risk of underperforming those investors who actively reinvest all the income coming from their portfolios. If you need income from your portfolios, it's important that you focus your withdrawals from a portfolio relative to what income you actually need, rather than just withdrawing all of the income from a portfolio. So reinvesting is an important concept. It's a very powerful concept, and it's something that you should manage as part of an investment strategy. Next slide. Compounding is another very important principle. I'm sure you're all familiar with this. This shouldn't be a new concept to most of you out there. But just to illustrate the importance of compounding, you see here two types of investors. They both invested the same amount of money, $2,000 per year for 10 years over a period of time. The difference between the two investors is that investor B postponed that investment by 5 years. And the difference in the ending value of the portfolios can be dramatic. So postponing your investments can have significant impacts on your overall final outcome as an investor because of the power of compounding. Every year, every month, every day that you are invested adds to your investments, which then adds more earnings on top of those earnings, and those get compounded over time. From a practical standpoint, the important message here is start early, start investing early, even if you're investing small amounts. Much better to invest small amounts over a long period of time than postponing your investments for later because of this negative consequences of that deferring investments can have in your final outcome. Next slide, please. Another important principle which this slide is talking to has to do with rebalancing. Rebalancing means once you have an investment strategy and decide what is the portfolio that you are going to be investing in, it's important to constantly monitor the composition of your portfolio and rebalance back to your original intended strategy. The consequence of not doing so is that, as illustrated here, a portfolio that was originally well balanced between stocks and bonds, if left to its own devices, if left without rebalancing over a period of time, in this case, 20 years between 1999 and 2019, that portfolio will naturally become much more risky. It will deviate from the original 50-50 allocation to something closer to 65 or 70% stocks versus only 35% bonds, which means a much riskier portfolio than it originally was. This can be counterproductive, right? Because it means that you might end up assuming much more risk than you would have otherwise want to assume much later in your horizon, when you're probably going to intend to be doing the opposite. As you get older, as you get closer to your investment objectives, it is more likely that you would want to be more conservative rather than more aggressive in your investments. So maintaining an eye on your asset allocation, rebalancing your portfolio over time is another very important principle of investing through a disciplined and strategic approach. Next slide, please. This slide is looking at the same concept from a slightly different point of view. Again, the importance of rebalancing. This is making the point that in the 50, I'm looking at the third column, the farthest to the right. The point here is that in the 50-year period between 1970, sorry, it's the first column to the left, the period between 1970 and 2019. A portfolio that is not being rebalanced would have earned 9.5. A portfolio that is not being rebalanced would have earned just a little bit less than a portfolio that is being rebalanced. So the price to pay for that small increase in performance is a very high price in terms of risk, right? So not rebalancing a portfolio can earn you a little bit of extra return because your portfolio becomes more aggressive, but the price you pay for that is a lot of extra risk. And you have to be mindful of whether your plan, your strategy, your circumstances allow for that risk. That is why rebalancing is very important. Next slide, please. This graph has to do with market timing. And I personally believe this is one of the most important concepts to consider as an investor. It's very tempting to try to invest when one thinks that it's safe to do so, and then not be invested when you might think that it's risky to do so. The risk, the consequence of trying to do that kind of market timing is that you might end up selling and buying at the wrong time. You might end up selling investments when prices are low and buying your investments when prices are high, which is the opposite of what you want to be doing as an investor. So this illustrates that the danger of doing that, the danger of timing the market. And the way it's illustrated is by showing you that if you would have invested $1 at the beginning of the period from between 1926 and 2019, that dollar would have been worth more than $9,000 at the end of that horizon. If you only missed the 51 best performance months in that whole horizon, if you only missed a very small percentage of the good months to be invested, all of your gain would have been wiped off, zero. All of that huge gain that could have been realized during that long period of time would have disappeared by simply not being invested in that very small percentage of good months during that horizon. So a large risk to trying to time the market if you get it wrong. It's very easy to get the timing of the market wrong, and the risk of getting it wrong is very high, as illustrated by this chart. So next slide, please. Same concept, but slightly different time frame. I won't spend too much time here, but again, between 2000 and 2019, you can get an idea for what the growth of a dollar invested would have been, and just missing 11 months out of that whole investment period would have been enough to wipe out all of your potential gain during the period. So market timing can have very negative consequences if you don't get it right. Next slide, please. This is looking at the same risk on a month-by-month basis, but I like the next slide better. The next slide, please. This is looking at the same idea if you are trying to time the market on a day-to-day basis, much less risky. If you look at the same investment period, 2000 to 2019, average return, very good, 6.1%. If you only missed 50 days, 50 investment days out of a total of possible investment days of 5,000, more than 5,000 trading days during that period. So if you only missed less than 1% of the good trading days in that period, you would effectively converted that potential 6% gain into a loss, a significant loss of 5.5%. So market timing is a very risky proposition. If you are someone who is inclined to day trade or to be looking at your account on a daily basis and be tweaking with your investments frequently, you have to be mindful of the potential risks that you assume of impairing your performance over time. Next slide, please. This is another relationship that I think is very important to understand as an investor. This is a relationship between time investment horizon and investment risk. The longer your investment horizon, the less likely you are to experience losses from any given risk asset, for any given investment. As illustrated in this chart, small stocks, which by definition is a very risky investment, when looked at over a 20-year period, never returned a loss. So if you invested in small cap stocks, very risky investment, very aggressive investment, as long as you invested for at least 20 years in this whole, any 20 years during this period, 1926 to 2019, you never would have experienced a loss in your investments. On the other hand, when you look at any 1 year period in the same time horizon, the same investment, small capitalization stocks, could have returned a very significant loss, close to 60% of your investment. So planning horizon has a lot to do with the level of risk you can assume as an investor. If your planning horizon is short and you're likely to use your funds in a short period of time rather than a long period of time, then it's important that you manage the risk and the volatility associated with your investments, and that you understand this relationship illustrated in this graph. The more conservative your investment, the less likely it is that your investment will experience a loss in any given time horizon. Next slide, please. Another important consideration for investors is inflation. Of course, unless your investments are able to keep up with inflation, you're going to suffer, you risk suffering a reduction in your future purchasing power. This graph shows the performance of some general asset classes before and after inflation for the period between 1926 and 2019. Very importantly, if you factor taxes, then you can clearly see that if your objective is to maintain your purchasing power or to grow your wealth, then it's very important to invest in stocks. No other investments are likely to produce positive after tax and after inflation returns. in the context of a portfolio, an investment portfolio. Next slide, please. So given what we have discussed so far about investment horizon, market timing, and the importance of equity investing, it should be easy to understand the importance that your individual risk tolerance has when designing an investment strategy. As this chart illustrates, realizing the long-term benefits of investing necessarily means having to tolerate volatility, the natural volatility that comes with any investment strategy. By definition, trying to earn higher returns requires assuming greater risk. So unfortunately, regardless of how good your investment strategy is, results will take time, and it will be difficult to accomplish your objectives if you end up having to quit your strategy because you're not able to tolerate the volatility that comes with it. So in this simple example, somebody who invested in 1972 would have seen a significant reduction in the value of those investments a short period of time later, by the end of 1974. If that investor had decided at this time, after experiencing losses, to become conservative and invest in a very conservative bond portfolio, then the final value of their portfolio after 20 years of investing would have been much less than if that investor had remained invested for that period of time. So being able to tolerate volatility, not getting scared by fluctuations in the market, and sticking to your investment strategy relative to your horizon, remaining invested over your investment horizon is very important for your ultimate success as an investor. Planning, designing your strategy, understanding your risk tolerance, and sticking to your plan is going to be key to your performance as an investor. Next slide, please. This is just a recap for your reference. These are the important general principles to keep in mind. Understand the benefits of reinvesting, compounding, rebalancing, avoid the risks of market timing, have an investment strategy that is suitable for your planning horizon, balance the risk of your strategy with your planning horizon, understand the impact of inflation on your investments, and be mindful of your individual tolerance for risk. Your two investors that have the same goals, the same objectives, the same assets might not necessarily end up with the same investment strategy because of their own personal preferences. Some people will tolerate volatility better than others, so understand yourself, understand how you might react to different market conditions as an investor before embarking in any type of investment program. Next slide, please. So now we're going to move on to general investment principles and discuss a little bit about portfolio construction, how to invest, how to design an investment strategy, and a smart portfolio. Generally speaking, an investment portfolio can be defined as being actively managed, passively managed, or somewhere in the middle. So what is an actively managed portfolio? An actively managed portfolio is expected to be a portfolio that holds a limited number of securities, a small number of investments that the investor thinks are undervalued or likely to grow higher than the average market. An active portfolio is also expected to trade very often in response to the valuation of the individual securities and market conditions. On the other hand, a passive portfolio is expected to have broad exposure across many different asset classes and many different types of securities, in proportion to the relative market valuation within the index, within the asset class. And a passive portfolio is not going to do a lot of trading other than to rebalance securities relative to their valuation within the portfolio. These two approaches represent a trade-off between cost and expected results. An active investment manager is willing to spend resources, research, time, management fees in exchange for outperforming a passive investment strategy. An active investor thinks that by investing time, money, effort into picking securities, picking undervalued investments, they are going to have a better investment performance than other investors. A passive investor will believe that it's not necessary to invest those resources and money in being active, because at the end, the excess returns, the extra return that will be achieved as an active investor is not going to justify the extra expense. So these are generally two approaches to in investment management that it's important to understand. And of course, there is something in between, which we're also going to discuss in a little bit of detail further on. Next slide, please. So at the heart of active investment management is asset valuation. Security analysts work hard to determine if a security trades above or below its fair market value, and they trade accordingly, attempting to take advantage of market inefficiencies that underprice securities relative to their value. This is very attractive in theory, but it's something very difficult to accomplish in practice. It takes a lot of effort, a lot of research, a lot of modeling to come up with accurate valuation of securities in general. And it is very rare in today's market environment, very efficient markets that we're going to be investing in generally. It's very difficult to find inefficiencies, even if you have an accurate value for what a security might be worth. Of course, if your valuation models and your analysis is incorrect, that can lead to very costly mistakes. If you believe you're buying an undervalued security, but in fact you're buying something that is overpriced, then you're exposing yourself to large potential losses and underperformance. Next slide, please. Here's just an overview of some of the generally used valuation methods for different types of asset classes. I won't spend a lot of time here, but as the point that I made before is valuing assets, modeling the value of an asset is not a simple thing to do. It's very complicated if you want to do it accurately. The risk of getting the price, the expected price of a security wrong is large. And even if you have an accurate value of a security, it's very difficult to find pricing inefficiencies in today's markets. Next slide, please. The point, the important point is here that I want to make here with regards to what I've just said before. Does it make sense to be an active manager? Is there any positive result or positive return that you can expect from active management? A lot of research has gone into that. This chart shows how difficult it is to be a successful active management. Apparently, active managers, professional active investment managers, are not very good at overperforming, at performing better than passive investors. This has been widely researched in recent years, and many studies seem to agree. This particular graph is showing you that a very small percentage of active managers actually manage to do better than a passively managed investment benchmark. Next slide, please. This chart also shows that of the investment managers that manage to do better than an index, so the top 25% of active investment managers, those that technically overperformed or did better than a passive investor in any given year, are very unlikely to also be overachievers, overperformance in any in the following 5 years after they had positive results. So it basically emphasizes what we just said before. Active management is very difficult to do. when achieved, past performance does not guarantee future performance. So it's very difficult to find investment managers that outperform passive investments at any given time, in any given year. If you do find them and you choose to invest in them, know that it's very unlikely that they will still outperform a passive investment strategy consistently over time going forward. So the past performance when it comes to active investment management is not a good predictor of future performance. Next slide, please. So with that introduction, it's important to understand what explains positive active investment performance. In the past, the conventional belief was that if you invested your money with a very good investment manager that had a lot of research, that had a lot of skill, that had a lot of experience, you would gain better results than the average investor. The average investor is reflected here. The average passive investor is reflected in this graph by the blue section called beta. And alpha refers to what a successful active investment manager might expect from their investment portfolios. So in the past, it was believed that alpha was the result of unique skills, experience, and other qualitative features of the investment manager. Modern research has proven that a lot of the alpha achieved by successful investment managers can actually be explained by quantitative factors that can be easily measured and replicated even by a computer, right? So unfortunately for active managers, this means that there's very little value in any special skills that they might think to have. Once you adjust performance of an active, successful investment manager to just a small number of qualitative investment factors, qualitative, again, statistical factors that can be easily measured and replicated by a computer. Once you adjust performance for the impact of those factors, there's very little additional performance left for an active investment manager to justify the effort and the fees that go into active investment management. Next slide, please. So you might be wondering, what are those important factors that have that result in good investment performance? And here's an introduction. Here are some of the generally agreed factors to have a good correlation to successful investment performance. Value is one of them. So fundamental valuation, fundamental value of your investment, of the companies you're investing in, is one factor that can be easily measured, quantified, and used to invest in securities that are likely to do better than other stocks. Size is another good predictor of investment performance. Over time, over an adequate planning horizon, smaller investments, smaller companies have shown to outperform larger companies. Quality is another factor. What is the quality of the earnings, the strength of the earnings of the companies that you're buying? Momentum is another factor. So recent trends in the price of a stock are also a good predictor for future trends over a period of time, over reasonable periods of time. So momentum is another thing that can be measured and used to quantitatively decide which companies to invest in. And volatility. Generally speaking, on a risk-adjusted basis, companies that have experienced less volatility, less fluctuation in their market prices over time are going to perform better than more volatile companies. So the point here is these are some of the factors, some of the metrics that computers and investment managers nowadays use to program computers to select individual securities, individual investments that are likely to outperform over time just a pure passive investment strategy. Next slide, please. This chart is showing you some of the benefits of investing according to some of these simple to measure and replicate investment factors. You can see that all of the factors that we have discussed over different time periods, over different time horizons, have outperformed passive investments. And very importantly, when combined, when these factors are combined and used to develop multi-factor portfolios, portfolios that consider multiple factors at the same time, it's very easy to outperform passive investment benchmarks over even short periods of time, 3, 5, 10 years. In all of these time frames, a multi-factor portfolio, multi-factor investment portfolio has generally been able to outperform a passive investment index, in this case, the MSCI USA investment benchmark. Next slide, please. So this is a very difficult chart to read, but the point here is very simple. Diversification is key to managing volatility, right? We talked about the factors, how you might go about building an investment portfolio, identifying securities or investments that you might want to make with simple to use metrics and quantitative factors that can be easily studied and identified. The other important concept is diversification, right? Building a portfolio that has broad exposure to different asset classes. The point here is, what is the benefit? What is the value of diversification? Every color in this chart represents an individual asset class, except for the dark red. The dark red square with the white letters represents a well-diversified investment portfolio, a 60-40 portfolio. And what this chart shows you is, for any given year between 1999 and 2018, it shows you how each asset class performed. What was the performance, what was the return of each individual asset class, ranked from highest to lowest, okay? In the far right, you see the average performance of all the asset classes over the entire horizon. What you want to notice here is the balanced portfolio, of course, as expected, performed average, right? It had over the entire horizon, its performance was average, was in the middle of the pack with regards to all the possible asset classes. But the volatility is much lower than any other asset class. When you look at where the balanced portfolio is in any given year, it's always somewhere in the middle, right? It's never too far to the top, but more importantly, never too far to the bottom. So its performance is much more predictable. It's much less volatile, right? It's much less volatile than even some of the asset classes that had lower performance on average, right? So by investing in a well-diversified balanced portfolio, what you're trying to do and what can be easily accomplished is performance which is average to any of the other possible individual investment asset classes that you can have, but much less volatile. And I will expand on this a little bit more in the next slide. Next slide, please. So the point before was that diversification, being exposed to different asset classes, is how you manage volatility and risk. There is such thing as an optimal investment portfolio. So analysts and researchers invest a lot of time and effort in understanding the volatility, right, the risk associated with different types of portfolios, different combinations of asset classes. And what they manage to do is they understand that by looking at the correlation between different asset classes, it is possible to build optimal portfolios for any level of risk that an investor is willing to assume. And that's what, at the end of the day, investing, as we said, is about. For any given risk that you assume, you want to maximize the performance, the benefit that you get for assuming that risk. And that's what an optimal investment portfolio is. Given that you don't want your portfolio to fluctuate in value more than 10% over time, then what is the optimal combination of investments, of assets, that is going to give me the best possible investment result for that level of risk? That is called the efficient frontier. That is something that in any investment strategy you should try to at least have an understanding for, and understand the benefits of diversification in terms of how it can make your portfolio as close as possible to the ideal, the theoretical ideal investment asset allocation. The one thing, this is a little bit technical, of course, there's no point in getting too much into the details of this graph, but there's one concept that is very important. And that concept is that it is possible to be too conservative. If you invest too conservatively, you might end up, even if you are optimal, even if you are in the efficient frontier, even if your portfolio is in the optimal place in this graph, if you are too conservative, you will end up at the bottom of this graph, which means that you will be able to have better performance with less risk if you change your portfolio. So you don't want to invest in a portfolio that, even if it is efficient, can be replaced by a better portfolio, and a portfolio that will yield you better expected returns with less risk. In other words, you have to be mindful of not being too conservative with your investments. It is possible to be inefficient by being too conservative in your investment strategies. Next slide, please. So that was quite a bit of information, but I do want to recap or summarize with something to take away from this discussion until now. When you're thinking about building an investment portfolio, building an investment strategy, what some of the theory that I have discussed will tell us is that asset allocation is first and foremost. The best thing that you can do in terms of building a smart portfolio is first and foremost considering your overall asset allocation. How much of your money is going to be exposed or invested in different general asset classes? How much of your money is going to be in international fixed income versus domestic small capitalization stocks versus mortgage-backed securities? So general big asset classes, your strategy for how much of your money to put into different investment asset classes is the first order of importance when it comes to your investment strategy. If you only do one thing, if you're trying to build an investment portfolio and you only do one thing, try to do your research and understand what could be an efficient allocation of your money to different asset classes in terms of managing the overall risk of the portfolio, and develop and put in place a very passive, a very low-cost investment strategy to achieve that desired asset allocation. That's number one order of importance when it comes to investing. Second order of importance is perhaps doing some factor analysis. Within any given asset class that you invest, you can do the type of factor analysis that we discussed and pick your investments within an asset class based on the factors that we introduced, that we discussed, that are known to be correlated or indicative of good investment performance. That should be the second level of analysis if you're interested in building a portfolio. Security valuation, trying to value individual securities and find investments that are undervalued, is a third option that you have. But as we said, should be very low in your priorities. and don't expect to get a lot out of that. You're going to put a lot of effort in it, and probably not going to get a lot in terms of additional benefits for your investment strategy. And last should be market timing. The strategy that might produce the least investment benefits for you as an investor in exchange for the risk that you assume is market timing. That is a very risky proposition, very difficult to do. As we discussed very early on, getting the timing of the market wrong can have very negative outcomes, very negative results for an investor. Next slide, please. A little bit of discussion on the practical aspects of building a portfolio. Investment funds are generally very easy and simple ways to invest. You can have a brokerage account, invest in mutual funds, ETFs, very simple ways to achieve diversification, very low cost nowadays. So diversification is important. Keeping your investment costs low is important. Mutual funds, exchange traded funds, ETFs, these are the types of investments that can help you do that with little effort and very small investment amounts. When you invest in mutual funds and ETFs, it's important to know that all of the earnings that are happening inside of your funds are going to be distributed to you. And very importantly, so you'll pay taxes, right? Distributions generate taxes. So the consequence of investing in mutual funds and ETFs is that you'll constantly be paying taxes. You'll be exposed to taxes as a result of the distributions you received. And very important for non-residents, we'll talk a little bit more about G4s in a minute, but very important for non-residents, your investments in mutual funds and exchange-traded funds will be generating distributions which will always be treated as US source income for tax purposes. So it will be taxed at a higher rate than other types of investments. Also for non-residents, you have to be mindful that owning mutual funds and exchange-traded funds can have consequences when you relocate outside of the US, and also estate tax consequences. If you are a non-resident of the US for estate tax inheritance purposes, your inheritance upon your passing, the transfer of your portfolio to your heirs may be subject to US estate taxes with a much lower minimum than for US residents. And investing in mutual funds and generally funds, investment funds, US-based investment funds can expose a non-resident to estate tax consequences as well. The alternative to investing in, to identifying, doing your research and buying your own mutual funds and exchange traded funds, the alternative to that is investing in managed accounts. Rather than buying shares of an investment fund, you can open a brokerage account that can be managed by a third party. You can open a brokerage account and then authorize investment manager, very large institutional investment management firms, to then build and manage a portfolio for you. These types of managed accounts can be set up to be very diversified. They can also be very low cost, as efficient from a cost perspective as mutual funds or ETFs, and generally can be more tax efficient for certain types of investors, particularly non-residents. Non-residents can have significant tax advantages, specifically tax-free interest, tax-free for international equity dividends, significant tax advantages if they invest in individual securities rather than mutual funds or exchange-traded funds. The only way for a non-resident investor to realize these advantages without having to go through the effort of building a large portfolio of many individual stocks and bonds is by investing through a managed investment account rather than through a US-based investment fund like a mutual fund or an ETF. Next slide, please. We briefly touched on tax management, managing the tax liabilities of your investment. This graph shows the potential benefits over the long term of investing tax efficiently, of deferring the taxation of your investments over time. Deferring the payment of taxes on an investment portfolio has the benefit of allowing the money that remains invested to compound over time. So deferring taxes over long investment horizons can have significant improvements in investment performance over time. And next slide, please. Some of the specific ways in which investors can defer taxes is, of course, by taking advantage of retirement accounts, individual retirement accounts, for example, IRAs, Roth IRAs, these types of programs, but also annuities. Investors have the option of investing inside of annuities, which are retirement contracts offered by insurance companies, which offer the same type of benefit. Tax deferred until funds are used for retirement. So depending on your circumstances, depending on what you're trying to accomplish, with some level of financial planning, it's important, if you can, to take advantage of tax deferral opportunities in your investment strategies. And next slide, please. I believe this is our last slide. Yes, I just want to wrap up with a few comments specific to G4s and non-resident investors. I've already touched a little bit about this. International organization employees in general are very unique, have unique investment circumstances. Your pensions are guaranteed by very solid institutions. Your taxes on your pensions can be reimbursed to some extent, or for the most part. Your pension has the benefit of inflation adjustment and survivor benefit. These are all very unique conditions. Not many employees out there have the benefits that international organization employees have when it comes to pension. So take advantage of this. And if you are a G4 visa holder, do not be afraid to invest just because you are a non-resident. Take advantage of your status. You are able to open non-resident investment accounts and take advantage of things like tax-free interest, tax-free foreign dividends. And you can also take advantage if you're married to a U.S. Resident spouse to be taxed jointly. These are the types of strategies that you should consider as a G4 to invest and to set your assets for growth in the future. And next slide, please. I'm going to skip this slide. This is a little bit more about investing as a G4. That's all I have for today. I am going to see if there's any questions in the chat. I don't see any questions. Do you see any, Marilyn?
I don't see any questions, actually. So if anybody does have a question, please put it in the Q&A bubble, and Jose will answer it right away. He is available to take those questions now, if anybody's interested. While we're waiting and for you to gather your questions, I'll just take the opportunity to advise everybody that this webinar has been recorded and it will be put up on the website within a week after this event. Additionally, please fill out our survey and make sure you go to idbglobalfcu.org to see all of the amazing webinars that we currently have featured within our schedule throughout the year. Anybody have any questions? And I'm just attaching the survey link here. Well, Jose, I have to say this was an amazing webinar. Lots of great, wonderful information to share with our membership. So thank you for being here today, and thank you for sharing the valuable insights. If there are no more questions or nothing additional, wait, was that me? Hold on a second, there could be one. Yes, there is one there, Jose.
Let me see. Can you recommend a managed account for investment? So the first thing I will say is you have to find a financial institution that you would like to work with. And I say this particularly because many of you out there are non-resident investors, G4s, or people who might eventually not remain in the US. So that's the first step that you should consider, finding a financial institution that is hopefully a global financial institution, and it's going to be able to work with you as a non-resident, or in the future, if you're no longer living in the US. That's perhaps the first level decision you should be considering. Based on your selection of investment institution, financial institution, you will have different options for investing through that particular financial institution. So you'll have to understand what offers, what products and services your broker will offer you. But you also have the option of working with an independent investment advisor. So you can also, and that's what my firm is. So we are not associated with a financial institution per se, an investment bank or a broker. We help our clients implement managed accounts and investment solutions regardless of their financial institution. So if you have an account at a broker that has an open platform, then your account can be serviced and managed by any number of independent investment advisors that can offer very specialized, very unique, very different types of investment solutions that are specific to your needs. So financial institution is important. Looking at the investment options of that financial institution and considering independent investment advisors that can help you manage your account is the key to coming up with the right investment strategy for a managed account. In today's market, can you have a fixed income annuity, like for example, that guarantees a fixed annual income and inflation protected? Yes, absolutely. So annuities are investment options designed for retirement purposes. So you can invest your funds, your assets through an annuity, which means that taxes, as previously said, taxes in your investments will be deferred. You will have the benefit of growth of your investments on a tax-deferred basis. And it also means that annuities can come with different types of guarantees. Annuities are offered by insurance companies, and in addition to investment options inside of those contracts, the insurance companies will also offer certain types of guarantees, such as lifetime income. So you can invest in an annuity, which the insurance company will guarantee the ability of converting it into a lifetime stream of income, which can, in some cases, for example, be inflation protected. So that's the benefit of annuities: tax deferral, guarantees offered by insurance companies. But all of these benefits come with a cost. There's no free lunch, as they say, right? So if you invest in an annuity, you should understand the benefits that that can come with it, but also the costs associated with it, and plan accordingly to do the right thing, the best thing, the most suitable thing for your particular circumstances.
Right.
Yeah,
I think that was it, right? Yeah.
I think that's it.
Thank you, Jose. Wonderful. Oh, we'll pop up one last question and then we will sign off.
Do you offer an individual meeting to explore options and services that you provide? Absolutely. I'm happy to meet any of you that have additional questions on anything that we discussed today, or that wants to explore ideas specific to your circumstances. I'm happy to set up a meeting for that purpose. And I guess they can have my contact through you.
Yes. Email cu.marketing@idbglobalfcu.org, and we will send you over Jose's contact information so you can reach out to him directly. All right, okay. Wonderful, everyone. Have a wonderful afternoon, and we'll see you soon. Bye-bye.
Thank you, everybody. Bye-bye.